What is going on, YouTube Nation? This is Dark Dividend. If you guys are new to my YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. So I bought 3 high-paying dividend stocks today. There was a huge dip in the market, and I'm going to explain to you why I bought these stocks. I'll do a quick review on them and explain why. One of them was added to my M1 Finance Dividend Portfolio, and this is a buyer's market right now. There's a huge dip in the stock market, and many people are capitalizing. So if you're new to this channel, make sure you subscribe, and you got to hit that notification bell. A lot of you guys are starting to, and you're starting to realize why, because I start pumping out videos like crazy. Even days that I work, I try to save one or do a speed run for you guys. So let's check these stocks out right now. So the first stock I want to go over is Hercules Capital. HTGC is a symbol, sitting at 1272. Its previous close is 1338. Its day range is 1268 to 1306. Year range is 1268 to 1909. The market cap is 1.57 billion US dollars. The volume is 1.72 million. The PE ratio is 13.39. The dividend yield is 10.39, which makes you do a little bit more digging. Anytime the dividend yield is a little bit higher, you need to check and see if it's a yield trap. So I'm going to explain to you why I'm going to buy this stock, and I believe in buying this stock. And again, this is not financial advice for entertainment purposes, only disclaimer in this description. By the way, you got to hit that notification bell after you subscribe. A lot of you guys wanted me to do reviews on this, and I have done numerous reviews on these business development companies. So, you got to hit that notification bell. All right, let's check these guys out. So the largest business development company focused on venture lending and the lender of choice for innovative entrepreneurs and their venture capital partners. So 230 plus IPO M&A exits, 570 companies funded, 14 billion in commitments, 2.7 billion in asset under management, 1,000 plus co-investments with VC and PE firms, and then 615.2 million new debt and equity commitments. So let's check these guys out a little bit more. So they serve life sciences, technology, SaaS, finance, sustainable and renewable, and special situations. So little bit more we need to look into them because they're a business development company. So since 2003, they've partnered with over 570 innovative companies in the technology, life sciences, sustainable and renewable, and special situations verticals. We're proud of the role that we played in helping these companies achieve success. And I need this caffeine to kick in. I've been studying like crazy for my exam that I have tomorrow, and hopefully I'll do well. They have technologies. Here's their sectors. Let's just say, I think a big one that I think is huge right now is drug delivery, diagnostics, energy storage, transportation, and healthcare services, as well as information services. So they have a pretty good wide variety of companies. So look at this. And IPA, Inexpo, I've heard of those guys actually. Medcall, I've heard of them. Oak Street Health. So they got a lot of things going on right now. And that's what makes these guys very unique as a business development company. Over 570 innovative companies. Okay, so that's huge. Let's check out their revenue and their dividend history. So remember, guys, business development companies and real estate investment trusts, 90% of what they make have to go back to investors. So if they don't, they pay a big penalty and they're in big trouble. So look at their revenue from 2015, 157. This is in millions US dollars. 2016, 175, 2017, 190, 2018, 207, 2019, 267, 2020, 287, and 2021, 280. So there is an increase in revenue. Now let me show you their dividend history. So since 2010, they've had a steady growth in their dividends. So 2010, it was 20 cents, 2011, 22 cents, 2012, 23 cents, and then 24 cents in 2012. And then 25 cents, and then 27 cents, and then 28 cents in 2013. 2014, 31 cents, and then they're stuck at 31 cents for a little bit. And then 2019, 2018, 19, they're at 33 cents. 2020, they crack 40 cents. 2020, they go down to 32 cents. It's kind of a given because of the pandemic. And then 2020, 34 cents, 37 cents, 39 cents, and then 48 cents. Right here, the payout ratio is a little high at 102%. I'm not too concerned right now. Number of dividend increases in the last 5 years is 10. Annualized dividend growth in 5 years is 1.26%. Annual dividend yield You bought one share, it's 132, and the yield is 9.87% per Zacks. I'm not too concerned yet about this payout ratio because, these guys are increasing revenue. And again, this is a risky one. So, you can get a big cut, going down to 32 cents, 48 cents, but it is at a discount. If a cut happens because of, another recession or something, or a huge stock market crash, that's fine. I'm going to continue to keep on buying. So I like their portfolio. I like the way their business development company strategy is, and I'm going to continue to buy with their dividend hikes over the past years and stuff. So again, 90% of what they make goes back to us as investors. Let's jump to the next dividend stock. This is the new kid on the block that I bought. KKR Capital Corp. It's sitting at 2034, dividend yield of 13.37. Whoa. PE ratio 2.50. Whoa. Volume 1.31 million. Market cap 5.77 billion US dollars. Year range 1971 to 2345. Day range 2026 to 2096, and its previous close is 2122. So why did I pull the trigger on these guys? I'll explain to you why. So KKR is a publicly traded business development company focused on providing customized debt solutions to private middle market U.S. companies. We seek to invest primarily in the senior secured debt and, to a lesser extent, to less subordinated debt of private middle market U.S. companies to achieve the best risk-adjusted returns to our investors. So again, in my M1 Finance Dividend Portfolio, I try to have that as a higher yield percentage. So once I get to $100,000, I start reinvesting. Things are going to be very exciting for that one. That's a high yield portfolio that I have. My E-Trade portfolio, that's a little bit more conservative, and I'm a little bit aggressive right now, buying more bank stocks. I just bought Arbor Realty Trust. I just bought 21 shares of Huntington Bank shares today because of the huge dip. But really, I like to focus and dollar cost average on my M1 Finance Dividend Portfolio, and this is the perfect one. Perfect business development company to add. And I'll go over their portfolio. They have 193 companies, 19% portfolio fair value in the top 10 portfolio companies. 87% of debt investments are floating rate. 76 million / 5.9 times median portfolio company leverage. 69% of their investments are senior secured debt. 8.3% weighted average annual yield on accruing debt investments. 1.5% non-accrual rate fair value, 90% lead, co-lead, and so origination. So let me go over their portfolio. So their top 10 industries: software and services, capital goods, healthcare equipment and services, commercial and professional services, credit opportunities, real estate, insurance, media and entertainment, consumer durables and apparel. I like this top portfolio with their industries: software and services, capital goods, healthcare equipment and services, and commercial and professional services. So these ones up here, I really like. Real estate's a little bit down in insurance, but that's fine because that's still part of their diversification. So here's our senior secured loans, first and second, 59.9, 8.6. So right there, I like the way things are going with these guys. And again, this can be a risk. So, CSWC and this one, don't be surprised if a dividend cut happens. I'm just buying the dip and seeing what happens. So, I can't confirm that I'm long in these guys, but I like the way things are going. Eventually, if things look really good, I could be long in them, but I'm buying the dip on these guys, and I like the way things are going. Let me show you their revenue and their dividend history. So here's the revenue. This is in millions US dollars. 474, 2016, 423, 2017, 419, 2018, 394. You're like, uh-oh. 2019, look at this huge increase in revenue. They're making a comeback. 779, 2020, 639, still better than 474 during a pandemic. And then 2021, 1,081. So they are increasing in revenue from 2015 to 2021. That's what attracted me to these guys. And I just like their high diversification of their portfolio. And I'll go over their dividend history. So 2019, they were 19 cents. 2020, they were 15 cents. And then 2020, they jumped up to 60 cents. 2021, 65 cents. 2022, 62 cents. Then 63 cents. And then 68 cents. And 75, 2022. Annualized dividend growth in 5 years, negative 7.45. Again, the business development companies, real estate investment trust, financial sector, those guys were hit hard. So that's kind of understandable with what's going on. The payout ratio is 92%. Number of dividend increases in the last 5 years is 4. Annual dividend per yield, 252 if you bought one share, and the yield is 11.88%. So this one, this one in CSWC, you just got to be a little careful with. I'll go over CSWC another time in Hercules Capital. So just be careful with these payout ratios right now. These ones are big risks, especially the business development companies. I think the safest one is Main Street Capital, as I went over in my previous video with the monthly dividend stocks. So these ones are risks. I'm going to show you one that's a huge risk, but I'm definitely buying this because it's a new kid on the block, and I like the way things are going with it, and especially its diversification. So let's check this out. This is a new mortgage-backed real estate investment trust that came out there, AFCG Gamma. I'll go over these guys to a lot of you guys that are new. Dividend yield is 13.31%, a PE ratio of 9.49, volume 164.82K, market cap 326.35 million US dollars. Year range is 1490 to 2550, day range is 1625 to 1698, and its previous close was 1715. So what do I like about these guys? So these guys are in the Mary Jane business. They're the leading provider of institutional loans to high-quality cannabis operators nationwide to all aspects of production, cultivation, processing, and distribution. They offer loans and related facilities, generally secured by substantial assets such as real estate licenses and cash flow. The years of combined lending expertise and real estate experience, AFC Gamma's principles are now focused on the exponential growth of the Mary Jane industry. So, AFC Gamma is a real estate investment trust which gives investors access to income generating commercial and real estate investments. Not only is a real estate vehicle appropriate for a real estate lender, but a REIT that offers investors several benefits. It's income oriented, with a REIT participants eligible for a security stream of distributions. And since the REITs earn their tax exemption by distributing at least 90% of their income to shareholders quarterly and a 20% qualified business income deduction, rates generally are more and higher yielding, and it says in parentheses, taxable cash flow to their investors. So they're very diversified. So this is what I like about them. So they like growth, partnership, and rigor. 14.5 transaction source, $483 million of deals committed. So let's check these guys out. So, and again, these guys are a new kid on the block. So 2020, this is in millions US dollars, 5.25 or $5.25. And then 2021, 3701. So this is a huge risk. All three of these that I have mentioned are a huge risk. But these guys are diversified in the Mary Jane business, and the Mary Jane business is starting to get bigger and bigger and stronger and faster with investors. And this is why I like these guys. And I'll show you their dividend history. So again, being a new kid on the block, they were 38 cents, then they jumped to 50 cents, and then they jumped to 55 cents in April. Payout ratio is 109%. They're new. I mean, that's one thing. You just got to watch these payout ratios. Now, I sold Penny Mac PMT because I didn't like the way things are looking, but these guys are so new. I'm just going to take the risk. Number of increases in the last 5 years is 3. Annual dividend growth in 5 years, it's not available, obviously. So if you bought one share, you made $2.20 with a 12.83% dividend yield. So I'm going to conclude this real quick. Business development companies are a huge risk. You see stocks like Prospect Capital. You see stocks like, let me give another example that took a huge hit. NLY, who have decreased their dividends over time. There have been business development companies that take a huge hit. Capitella Finance, that's another one. I'm pretty sure that's a business development company. Those guys, CPTA, you guys remember them? I mean, people really emphasize those guys. They're just, a lot of them, sometimes there's not a lot of consistency. So these three are very risky. And, I provided my rationales to you guys as to why I bought them. And again, I'm not giving financial advice for entertainment purposes only, disclaimer in the description. I like their portfolios and their diversity, and this is why I bought them. And I have them in my M1 Finance Dividend Portfolio. So if you're new to this channel, make sure you subscribe and hit the notification bell so you don't miss future videos. Smash that like button for me. I would appreciate it. We're almost at 9,000 dividend warriors strong. So you guys have been amazing on this channel. Can't wait to get to 10,000 with you guys. Hopefully by the end of the year, we'll get to 10,000, maybe even sooner than that. But I would appreciate if you guys make some comments in the comment section, smash that like button, hit that notification bell. So you guys have a great Monday, and I'll post a video tomorrow. So be safe out there, and let me know what stocks you bought with the dip. Take care.